Hey, what's up, my YouTube fam? This is Larry with Invest and Build Your Credit and Wealth. And today we're going to be talking about investing. I know I've been putting out, like, I want to get in and do some classes, and a lot of people have been emailing me about, hey, Larry, I really want to learn more about investing. I know you're talking about it, and I say yes, I will start giving some classes from step one because some people are clueless about investing, and we're going to start today. So hey, I appreciate all my new subscribers. Please like, subscribe, and share the channel. This channel is really all about helping people improve their credit and also about investing and learning how to invest your money, let your money grow for you so you can strengthen your financial health. Right. So I want to put this out. I am not a financial advisor. So this information that I'm giving you, really please do your own research. When we talk about stocks and what I'm investing in, right? You got to make sure that this is a part of your portfolio or your investment strategy, what works for you. Do your own research so you can learn. That's what I did. I started following people, listening to people, but I did my research. And just when I started investing, I went from $100 to $26,000 in 10 months, right? And my philosophy behind that is I am the most, a lot of people make a lot of mistakes. I ask this question all the time with people I work with, other people. I say, what is the first bill you pay? What is the most important bill you pay when you get paid? Most people say my mortgage, my rent, food, car, all that type of stuff. The first bill you should be paying is yourself. And that's where a lot of people mind their process and what they're thinking about their finances wrong. And that's why they're stuck in these financial situations, right? They're stuck with their financial situations with their credit, being able to have access to money, not having money in their account because their philosophy on what they do when they get paid is backwards. Remember, you're paying all these bills that you're paying, and I'm not saying don't pay your bills, but all these people you're paying, listen, you're building their wealth, you're growing their portfolio, and you're discarding yours. Like, you're not saying that mine is important, right? Because most times when you get to start paying all your bills and then you get down to a certain amount of money, now you become stingy. You become tight because you're worried about having zero in that account and you're trying to make it last till the next pay period. So you're buying things, do this thing, you're doing this, maybe some things you didn't need, but you bought, and now you're at this point. And now every month that process causes you never to invest. So the first person you should be investing is you. $50, $100, 200, 300. You take that money, you invest in yourself. Now, everything else you pay your bills, and what's left, that's all you have. But the one thing you did, you invested back into yourself to help you grow your wealth, right? To help you look for retirement. To not being able, once you do retire, you got to downsize to something you don't want to live in and struggle in the latter years of your life because you didn't take investing serious now. So my philosophy, and not change, my philosophy is I invest first. When I get paid, I invest. When my wife get paid, I invest. Right? We continue to invest. And then if some tragedy happens or something happens, we know we have the funds to go and make it through and not have to suffer. Right? And this is what I'm talking about in investing. This is what I want y'all to start change. First thing, change your mindset on what you do. It ain't about how much money you make. It's about what you do with the money that you do make. That's the main thing. And I'm telling you this. When I started, listen, when we moved to California, it wasn't that I wasn't making good money. My wife wasn't making good money. But our bank accounts didn't represent the money that we was making. First of all, our credit wasn't where it needed to be, and then what we wasn't investing in ourselves. We was investing in everybody else, doing everything else, and pushing us out, not just living, right? But once I got into credit, I realized, like, man, my thought process is so backwards in what I'm trying to do and where I want to be and what are the things that I want to do. I'm not. I'm my thought process is backwards. So once I started getting in investing, I said I have to take care of me first. Like, why am I not paying me, but I'm paying everybody else's company and and creating wealth for them, sending their kids off to the best colleges, and I'm not even taking that philosophy and taking care of me. So I changed that, and that's what every single one of y'all have to do. You have to change how you think about money and where you want to be. We all have to sacrifice in the things that we want versus the things that we need so we can invest in ourselves so we can eventually buy whatever we need and not have to blink an eye at it, right? So, and that's what we want to talk about. So, please like, subscribe to this channel. I have a personal Fidelity account, but I opened up today a Webull account waiting for approval. So the first thing we're going to talk about is you need to open up a brokerage account. If you have any questions on how to open up a brokerage account, email me. I will send you the steps, different brokerage accounts that you can open up. But you definitely, first thing, change your mindset. Second thing, open up a brokerage account. Third thing, look at your finances. Say, how could I legitimately, I don't care if it's $20. You have to start. That is the main thing. $20, and we're going to talk about this, can change to 1,000. That could change to 10,000. That could change to 30,000. That could change to 50,000. That could change to 100,000. But the point is, you have to start, right? So the first thing we're gonna kind of throw out myths, right? So the first thing is we're gonna talk about. A lot of people say, "Well, I don't like stock because it's gambling," which is a myth and it scares people, right, from investing. Listen. There's rich folks out here, they invest all the time and they stay rich and they continue to pass that wealth on to family and family because they understand one key thing, compound interest, and we're going to talk a little bit about that too. So I don't want to make this video too long, but we're going to talk about some key things. We're going to talk about the S&P 500. We're going to be talking about the different sectors. And then we're going to cover a little bit about investing, talk a little bit about investing for beginners. And then we're going to continue with this education. And we're going to continue to move forward for people that want to learn more about investing. I'm like I said, I'm opening up a Webull account. I'm going to invest, but I'm going to share my portfolio with you while I'm investing in these companies. Again, I'm not a financial advisor, so any information I give you, please, please, please do your research, right? Do it. Make sure it's a part of your investment strategy, and we're going to talk about all of those things. But remember, I'm just opening the door for you. I'm opening the door so you can walk in, so you can have some idea. It is your job to continue to do your research, understand what you're getting into, and grow your mindset so you can change your financial future. And that's what I've done. So the first thing we want to talk about is the S&P 500. I'm going to go over the history of the S&P 500, how many years were negative, how many years was positive. I want you to add them up so you get a good idea. So we're going to take this myth about gambling out and we're going to go through it. So we're going to talk about, so from year 1928, right, to 1931, there were 4 years that the S&P was in a negative status. There was only 1 year in a positive. So make sure you mark that down. We're going to add this up. From 1932 to 1944, there were 6 years that was negative, 7 years that were positive in that 12-year span. Okay, the next 12 years, from 1945 to 1957, there were 5 negative years and there were 8 positive years. But let me just give a quick, let's stop and let's go over the numbers of those years. In 1945, the S&P was up 30.72%. In 1946, it was negative 11.87%. In 1947, it was at 0.00%, so it even. 1948, it was at a negative 0.65%. In 1949, it was up 10.26%. 1950, it was up 21.78%. 1951, it was up 16.46%. 1952, 11.78%. 1953, it was negative 6.62. 1954, it was up 45.2%. 1955, 26.40%. 1956, 2.62%. 1957, it was up 14.31. It was negative 14.31%. So it's 5 years negative. Really, if you take out the zero when it was even, it was only negative 4 out of the 8 years, right? So from 1958 to 1970, it was negative 4 years and it was positive 9 years. All right. So from 1971 to 1983, it was negative 4 years and it was positive 9 years. I hope you're adding this up. From 1984 to 1996, it was only negative 2 years. It was plus 11 years, right? So the 2 down years, it was only negative 6.65 and 1.54. There were 1, 2, 3, 4 years that it was up over 20%. 1 year that it was up over 30%, and then 2 years that it was over 10%, and the rest were under 10%. Right? So from 1997 to 2009, it was negative 4 years and plus 9 years. So from 2010 to 2022, which is this year, down 3 years and up 9 years. This 2022, the S&P is down 19.74%. I'm telling you, this is a time for new investors to get into the market because there are great companies that are such low prices, and we're going to talk a little bit about that. I'm going to cover just a couple that I invested in, that I'm continuing to invest in, but I am lowering my cost per share because as the stocks get cheaper, I'm buying it cheaper, which is lowering my cost per share. So a total, there were 31 years in the negative, 63 years, double, were in the positive. And if you go look at the percentage, the years it was plus, you had no choice but to make money. So don't let people tell you it's gambling. It is looking in great companies and putting your money to work and making money while you sleep, while you're working at another job, but your money is at work. So I wanted to really cover that with you, to go over that, because it's so important for you to understand the S&P 500, and we'll get more on what companies are in the S&P 500. We'll talk about the S&P 500. We'll talk about the New York. We'll talk about the Dow. We'll talk about the Dow. We'll talk about other indexes, index, trying to find the word, what stocks are involved in, because you got penny stocks, you got the S&P 500, you got the Dow, you got the NASDAQ. So you got all these different ones where different companies are in. So we're gonna talk, and we'll get deeper on that too. We're gonna get deeper in companies. So the next thing we want to talk about is sectors, because you have to understand the sectors so you can diversify your portfolio. And you want to diversify your portfolios because if one sector is down and another sector is up, you kind of absorb the negative one sector because the next sector is up, and that's what they want. You want your portfolio to be diversified. You don't want to be all in one sector, because when that sector is down, your whole portfolio is down. For example, right now, there's now if you're in, say, in technology stocks, is down, but if you're in energy stocks, they're up. So for example, I got into an energy stock, OB, I think it's OBE. When I first got into it, as inflation moves, only $3 a share. That stock has went up as much as $12 a share. I think right now, it kind of fell. It's around $8 a share. So I'm over 100% on that stock, right? Steady put money into it, right? Because as it dips, I buy, and then I continue. So that's what about. But I do have some technology stocks like AMD and Nvidia, which are down, right? So, but I am buying because that stock price, and we'll talk a little bit about that, is going down. There's other things like real estate and REITs, right, that draw dividends where you can get dividends from the stocks. So quarterly dividends pay out as you continue. There are a lot of people that live off their dividends because they've been purchasing these stocks for so long and they're getting payout. Some people may get a $5,000 payout a quarterly because of all the investments. So that's an additional $20,000 that you get in the 4 quarters, $5,000 that you can reinvest back into your stocks. That's what people are doing. Like, they're taking these strategies and growing their wealth. So just imagine you've been investing in a company. Every quarter you get $5,000. You take that 5,000 and you reinvest it back in those companies that continue to grow your dividends and grow your portfolio. So that's some of the great things. So you have 11 sectors. Let's talk about the sectors. One is energy. The energy sector includes companies engaged in exploration and production of oil and other hydrocarbonated refinery. The transportation of oil and gas and the productions of oil and gas equipment. The sector is generally mature with modest growth, right? So the next one is material. Material sector include companies that produce chemical, glass, paper, packaging, construction material, and steel. It tends to be a mature industry with modest growth potential. The next one is industrial. Industrial sector include companies that manufacture and defense products, electronic equipment, and construction equipment, like 3M, Caterpillar. So those some of the great companies in that industry. The next one is consumer discretionary. Consumer discretionary sector includes companies that produce cars, durable goods, clothing, leisure equipment. Uh, Best known companies: Amazon, Ford Motor Company, Home Depot. Home Depot is another great one. And did you know Home Depot bought uh, HD Supply? So these grow companies are growing. And then there's particular sectors like that you can get like ETF, like Vanguard. So we'll talk about ETFs too. Number 5, consumer staples. Consumer staples sectors include companies that produce food, drink, and tobacco, non-durable household good, as well as retails that sell food, drug, including retailing supermarkets. Some of the great ones: Coca-Cola, Procter and Gamble, Walmart. The next one is healthcare. Right, healthcare sector include companies that provide healthcare services. Big companies: Pfizer, Johnson and Johnson, United Health. Uh, Another one, number 7, is financials. Financial sectors consist of companies involved in banking, including mortgage, consumer finances, as well as investment banks, brokerage firms, and insurance companies. Information technology, number 8. The information technology sector are companies like Apple, Microsoft, Nvidia. Communication services. Communication service sector include telemarketing and media companies. Best known company is Disney, Facebook, Verizon. Number 10, utilities. Sectors include companies included in electricity, right? Best known companies is utility sector is SPDR Fund, uh, Dominion Energy, Duke Energy, Nextra Energy. The next one is real estate. Number 11, real estate sector includes real estate services, real estate development, equity REITs. This sector may offer strong growth opportunities, but shows steady growth overall. Great companies, American Tower, Public Storage, Simmons Property Group, and these companies pay out dividends, right? Listen, the bottom line is understand the company is a fit into a sector classification that can be helpful to your diversity in your portfolio and include companies from a broad range of sectors. Also, just notice some of these companies could be operating in different sectors, right? Because they're broad companies and they could be working in different sectors, which may be really good. The main thing you want to understand is that investing is important. Understand the sectors will help you get with the great companies, diversify your portfolio so you maintain a strong portfolio, right? Right now, again, great time for y'all new investors to be getting in. Now, a lot of people that's been in there, been investing. Now you're gonna, you're watching in CNBC. A lot of those people, they're investors, so they're losing money. They got money tied up, but you're new. You have a great opportunity to get into the stock market at cheap prices for these great companies. Because as you see, the stock market will turn. There were millionaires made after the housing market, 2012, and when COVID hit. People became millionaires in the stock market because of how the dips were so vast. And then they got their money in. And as the market turned around, they were making tons of money. This is another opportunity for you. This is a boat you don't want to miss, because when this turns, it may be a while before this happens again. So be smart. Get in. Start taking this opportunity. Right. So I'm gonna cover a few things, and I'm gonna go over a few things with you, and then we're gonna continue with this video, and we're gonna continue to grow. We're gonna continue to get y'all investing, because I need y'all to be making this money so you can open up a business or grow your business or grow your financial wealth. So, have you ever wondered why rich people, right? Rich people keep growing. And they keep growing because they're investing, right? That is the most thing. Investing from the ground up. This is what we're doing. We're going to be investing from the ground up. Now, what some people are so impatient. Investing is not a get rich scheme, right? It is a process of commitment to grow your wealth. And for me, when I started seeing my portfolio from 3,000, 100, 1,000 to 3,000 to 5,000 to 8,000, 11,000, 14,000, 15,000, I'm like, wow, man, this thing is really growing in a short period of time. If I knew this back when I was young, man, I would not be working a job. No way would I be working a job, because just how the stock market works and what I learned and educated myself on is, my man, there's no way, right? But a lot of us are not educated. We don't want to know. We don't seek out the right information. Now, man, I'm on a whole different level when it comes to financing, right? So it's not a get rich, but it's a process for you to earn and grow your wealth. And that's the main thing that I want to talk about with y'all. And the main thing is compound interest. Compound interest. If you think there are compound interest calculators out there. For example, I did a video. It was an earlier video. Maybe I need to pop it up on this one of when I did a compound. I took my mortgage when I was in California, and I stayed in this house for 3 years. And I said, if I would invest just 1 month, and then every month I would have invested that money back into every month at a 7% interest rate annually, right? In 3 years, I would have went from that $2,750 to $1,003 investing at a small 7% interest. That is compound interest. That is interest on top of interest on top of interest on top of interest. Because every time you stack that interest on top of there, that power grows. And then from there, that 7% is based on that. And that power continues to grow. Compound interest is the main thing. Interest is making your money work for you. That's what it is. It is making it work. It is nice. I was days where I would be at work and I would look at my portfolio at the end of the day and say, I made $1,000 today. I made $1,500 today. I made $2,000 today. Right? It's days I say, oh man, I lost $300. I lost $400. And then 3 days later, I didn't gain that and plus some. So it's all about making your money work for you, right? There's stocks, there's bonds, there's mutual funds, right? There's so many different areas. There's option trading. We'll talk about more about that. There's so many ways that you can make money in the stock market once you learn and understand it. Investing is not gambling. We talked about that. It is not gambling. It comes at a risk, right? But it's not gambling. And I just want to make that clear because some people be thinking, well, it's gambling. It's not gambling. Think all these people are going to be gambling their money. People are becoming millionaires and investing. That is not gambling. And if you continue that mindset, you're going to continue to have your bank account suffer because your mindset is backwards, right? It is backwards. So, truth investing doesn't happen without some of a part A real investors that do not simply throw his money at any random investment. He or she performs thorough analysis and commit capital only when there is a reasonable expectation of profit. That's why it's not gambling. It's because you're taking an analysis, you're looking at a company, you're researching this company. Is this a great company to be in? What are their growth potential? How much debt are they carrying? Are they strapped with a lot of debt? Right? What are their earnings per share? What are they when they have their earning calls? Are they going up? What is they what information are they putting out about the company, right? So there's a lot of things that go along with that that helps you make great decisions about a stock, right? So listen, again, it is all about growing your wealth. Look up, do your research. Class 1, compound interest. Look up compound interest. Do some research on compound interest. So I'm gonna give you a brief example. If you invest $10,000 today at 6%, you will have 10,600 in 1 year. 10,000 times 1.06. Now let's see that rather you withdrew the 6,000 gain from interest, you kept it in there for another year. If you continue to earn the same rate of 6% on your investment, you will grow to $11,236, right? At 10,006 times 1.6 by the end of your second year. So that is compound interest, right? You made $600 on there, you kept it in there. Another year later, you had $11,236 in that account because of compound interest. So again, there are compound interest calculators out there. You definitely do some research on compound interest. We're going to do some more research on beginning investments. We're going to talk more about. We're going to talk about stocks. We're going to talk about opening a brokerage account. I'm going to bring you along step by step in this journey for y'all to change our financial wealth and then to grow in this investment. So I appreciate y'all for hanging out. If you have any questions, please let me know. I am going to put together another like an ebook to help people with beginning investment. Put a lot of stuff in there, so they help y'all out. So please, I'm gonna start doing all this stuff and make a whole nother a master investment guide. So to help people with investments and things like that, we're gonna talk about a lot of different things, great apps to go to, how to research stock. We're gonna talk about so many different things in this journey. So first thing I need you to do, change your mindset. Next thing we're gonna talk about brokerage firms to open up on the next class. But do your research, look at some brokerage accounts. If you have a job and you already have a Fidelity, you all you got to do is open up a brokerage account in that same one. So we'll talk about all of that. Please like and subscribe to the channel. If you have any questions, you definitely could email me. It's in the description, and we'll get back with you, because we're going to get on this journey. We're going to talk credit, we're going to talk investing. So I appreciate everything. I appreciate y'all hanging out with me, and I'm out.